thank you for joining us. The topic of this is mythbusters, right? And the whole idea is to take the talent of my fellow panelists here and maybe give you a different perspective on some of those adages of if it does this, then it means that. So the way we're going to handle this is that my two compatriots here are going to each present a perspective on different economic factors or geopolitical factors or whatever that they think may be things to consider with respect to the economy and the real estate industry. And then we're going to have a little conversation about those points and then maybe a few things I just decided to cook up while I was sitting at home the other day. And then we're going to open it up for some questions. So hopefully that works. Hopefully this will be interesting. We're going to start off with my compatriot here to the left, Ben Breslow from JLL.
Great. Thanks, Collete. Welcome, everyone. Let me see if I can get the slides up here. So in the spirit of the election cycle, I feel like maybe I should filibuster for a while to keep Josh off the stage.
Gridlock is not acceptable today.
I will prove that point wrong for sure. So again, thanks for coming. It's been great to be here at ULI. I'm Ben Breslow. I run research for JLL across the Americas. Based out of Boston, have a big team of analysts studying all sorts of local markets and around the Americas, but I also sit on an executive board that does some strategy work and guides our research strategy across the world. So we're in about 80 countries around the world, so I have a pretty good perspective. My view currently is that this has sort of been, that old adage of the markets climbing a wall of worry is kind of a good fit for what we're going through right now. It doesn't feel, it just constantly felt like this precarious position through this expansion, kind of like the image that you see up there. And I'm going to try to tell you, my view, it's not quite as bad as it feels. Not that there's no risk out there, but it's not quite as bad as it feels. So this is why it feels so bad, right? The headlines have been about as unsettling as I can remember in a stretch. Just in the past year to 15 months, we've had the aftermath of the scare in China with growth slowing and the stock market crash there. You had the precipitous drop in oil prices. You had the first Fed hike. You had the stock market correction here in the US and around the world with the financial jitters after some of those things. You, of course, had Brexit thrown in there, mixed the stew around a little bit, and now we're coming up on an election and a potential another Fed hike. And this is all in an environment, as if all of that isn't enough, with 40% of the world's developed market sovereign bonds in negative interest territory. So you mix all that up and you watch CNBC or you read the Wall Street Journal or you check your Twitter feed in between meetings. It's a pretty scary concoction. My view is that, not that none of this stuff matters, but it's much more important to look at sort of the fundamentals of where things are, where pricing is, where the underlying growth rates are, than all of this stuff. This is a lot of noise that is frankly overly negative. We'll talk about some of it in a little bit more detail in the panel, I'm sure. But the result is clearly this, somewhat of I'd call it a bit of a herd mentality toward this feeling of uncertainty. This is a statistic. There's all these new statistics people start looking at. These are three academics, one from Stanford, one from University of Chicago, one from Northwestern, that created an algorithm that counts the number of times that the words uncertain and uncertainty appear next to other relevant words like economy or politics or financial markets. So this is one of these sort of new age, I guess, social media, digital world kind of metrics. And it shows you that we're at an all-time high in terms of uncertainty. It's part of why everybody doesn't feel great. Although the adage of climbing a wall of worry, if you think about that last 15 months of uncertainty that we went through and all those risk factors, any one of them you would think could knock us off. The S&P is up 6%, 7%, I can't remember, I haven't looked at the number today, but the real estate markets, although there's some caution in the investment world, the real estate markets have been sort of clawing their way forward for the most part. So the question then becomes, where are we in the cycle? What does the real estate side of this look like? And I want to start global, and then I'll hone in a little bit on the US. This is really just to set the stage, and Josh will share some slides, and then we'll discuss. But the answer to that question of sort of where are we in the cycle from a real estate markets perspective, these are our office clocks that you probably see from JLL. The markets tend to rotate around the clocks, and the right side of the clock is kind of falling markets with high vacancy and falling demand and dropping rents. The left side of the market is more landlord favorable with rising rents and typically construction. The markets, if you look globally, are kind of all over the place. Certainly the US markets generally are kind of clustered in the rising side on the left, and some of them getting into the peaking phase. But Houston and London a year ago or 2 years ago were on the other side. They've flipped over. You've got places like Moscow and Sao Paulo. The famous bricks have become the icks. Those have been sort of mired in these long-term recessions without a lot of hope, seemingly at this point. You've got some other markets like, Amsterdam or Milan or Boston that sort of are kind of, feel like they're on a pretty good upswing for a variety of reasons. So the macro trends don't always tell the story. The micro trends are critically important. I'm going to talk a little bit about the U.S., where I think we are in the U.S. cycle, and give a little comparison. I'm going to ask a quick show of hands, first of all. If I told you an over-underline of 2 years from now, so October 27th, 2018, show of hands, how many people think this expansion cycle in the U.S. ends before that date? October 2018. So the rest is after. So show of hands after, because I can't quite see them. I'm not good at counting that fast. Okay, so we're actually, the consensus is a little bit later in that, which worries me for my prediction, actually, that I'm about to make. So this is the current cycle from the start of the expansion in terms of the number of quarters of GDP growth. Would look a little different if you did it with employment or some other factors, but just pure GDP growth. The gray line is the current cycle. The white line is the previous cycle, and the red line is the one before that in the 90s. Obviously, you see this has been a slower cycle in terms of growth. It's been good but not great sort of most of the time with this uncertainty hanging over us. Our view is that this growth cycle is more likely to last another 3 to 4 years than it is 1 to 2. There's a couple reasons for that. One is all the academic research coming out of this past recession showed, and it's really proved out, that balance sheet recoveries after balance sheet recessions are slower and take longer. That's been certainly frustrating, but true. The second is that the U.S. economy, which we're looking at right here, is really a fairly domestic economy. Yes, there's a lot of global interconnections, but a fairly domestic economy. 70%-ish of our economy is the consumer, and there's a pretty good tailwind now from the consumer side, even though there's some struggles on the business investment side from relatively still cheap oil, housing market that's finally growing, and most importantly, job growth and wage growth. So our view, and we can talk about it a little bit on the panel potentially, is that growth is likely to last a little longer than people think, despite all of that uncertainty out there. Now, you can't get through a presentation without talking about politics. I usually try to head that off with some electorate sentiment, which I think you see clearly on the signs on the bottom here. Maybe we'll talk about this a little bit in the panel, so I won't go too deeply into it, but my view is pray for gridlock. Not only pray for gridlock, but people this is, I think, one of those sort of myths that people just assume, the certain president gets in or not, and we're in so much trouble. We spend way too much time and energy on campaign rhetoric in terms of analyzing potential policies for the primary reason that the US government, our founding fathers, literally designed our government for gridlock. So when I say pray for gridlock, if you believe the polls today, it's probably most likely to stay some form of gridlock. I think there are some alternatives that could spell trouble or more positive things, which we can talk about. But generally, I think, despite, again, all the headlines on the election, we're going to make it through and be just fine. And the other big thing, sort of, it's going to be an exciting fourth quarter with the election and then the Fed. The green line that you're seeing is the Fed funds rate. The forecasts there are the Fed itself is the top forecast. Interestingly, the Fed is the entity that sets short-term rates in the U.S. and they've had by far the worst track record of predicting rates, probably of anyone out there. That same sort of hockey stick line you could bring all the way back. The middle line is an economics firm that we subscribe to, but kind of the consensus. And the bottom line is the bond market, which in the short term has been much more right and is predicting sort of lower for longer in terms of interest rates. And I'm sure we'll talk about that a little bit too. But a good thing, generally speaking, slow, steady growth and low interest rates is generally a pretty good thing for real estate. Just to hit a couple things really quick. Obviously, this cycle has been a little slower on the construction end outside of apartments. Even apartments, if you go way back past this last cycle, is not too out of whack from a general production perspective. And our view is that this is going to help dampen whatever cycle we go through to some extent, and in fact lead to some further rental spikes in certain areas as well. Debt loads, we had this huge run up in mortgage debt leading up to the last cycle, and this one's been much more equity driven, so less leverage in the system, lower loan to values, which I think again is a good thing in terms of potentially lengthening the cycle and also protecting us a little bit on the downside on this one. I talk a lot about the economic cycle, and I talked a little bit about the political and monetary cycle. I think it's critical to look at the demographic cycle too. This is the sort of the classic demographic pyramid for the US, which has not only the baby boom, which you can clearly see, but the echo boom of the millennials. So we're partially at least replenishing our workforce and our labor force, which is, ultimately we're going to have a little bit of a demographic drag as well, but not nearly as bad as places like Europe and Japan. So I think there's some good news there. And lastly, again, a little bit of the bull case for real estate, despite all the jitters and the concerns out there, is the structural shift toward allocations to alternative investments, real assets. I'm showing the sort of pension fund world here, which is about a third of the real estate allocations, and I think a good proxy, but you could go down the stack of insurance companies and others and see that there's a bit of a structural shift in a low yield environment to real assets, to income producing assets, and to diversification. And I think all of those things, especially with uncertainty around the world, are good for the US. So with that, I will turn it over to the bear.
Thanks, Ben. Okay, I'm going to start by talking about kind of collective sentiment as measured by all of us as participants in the ULI survey, and pick on that a little bit. And then talk about some of the noise that I think we give a little too much credence to, and then talk about pricing, which I think is really the signal that we should all be focusing in on. So to start, so if you look at the scores that we all send into ULI's Emerging Trends Survey every year, they used to be from 1 to 10, now they're 1 to 5, but you can kind of make an adjustment. And you look over the course of the years and what those results have indicated in terms of future price growth. There's a negative relationship, so that the more or the higher a market scores in terms of our expectations for is it a good place to invest, the weaker future price growth has been. And it's significant, and the negative relationship is very, very real. And vice versa, when a market like Houston today scores very poorly, that tends to historically lead to stronger price growth over the following 5 years. So, and it almost has to be that way, because when capital markets and the collective capital is very interested in an individual market, that tends to increase competition, which drives prices up and then suppresses future price growth. So that's something that I pay a lot of attention to, that sentiment. If you look at just this week's results with the 2017 Emerging Trends Survey, the markets like Austin and Dallas that scored 1, 2 are well above kind of their historical average in terms of individuals' perspectives on them. But the markets that are really that we're overly excited about are secondary markets. So Philadelphia, Salt Lake City, Indianapolis, Tampa Bay, and Baltimore are all scoring in 2017 at more than 1.7 standard deviations above their historical average. And the ones that are scoring less than a half a standard deviation above their historical average, I mentioned Houston, but Sacramento and St. Louis, and everything else is more than a half a standard deviation above average. Collectively, if you look at the average of kind of the top 30 markets, the scores suggest future average annual returns over the next 5 years of about 0.5 to 1%. So that's a little concerning.
There we go.
We got to go.
What happened? We found you.
Someone else is controlling it. 0.5% collectively on average across kind of the top 30 markets. That's historically what it suggests. And that relationship between sentiment and future price growth or future total returns is strong enough that you can actually forecast it with some degree of accuracy. So every one of these little circles here is an individual observation. So it's a market in some year since 2004, and the score is at the x-axis, right? So again, they scored it. It's looking at the scores of each market relative to their own historical averages, so it's a z-score kind of concept. And the 5-year forward return for that market is on the y-axis. So you can see this very strong and negative relationship. And you can also see, again, with an average score of 1.3 today, kind of down in that bottom right-hand corner, what that has translated to, that 0.5% average annual return over the following 5 years. So I've kind of labeled a few of the markets here. So San Francisco in 2004, the score for it, kind of on that, again, that 1 to 10 scale was 5.1, all right? Typically, San Francisco scores pretty high, but 5.1 was well below its historical average of 6.5. So you can see that blue dot there in the top left-hand corner. That's San Francisco in 2004. What happened over the following 5 years? Average annual returns were close to 14%, and this very kind of strong negative relationship. So another way of looking at this kind of same data more collectively and thinking about sentiment, trailing returns, and future price growth, instead of using those z-score concepts, I've actually just created some buckets and labeled them. So I think of this from a capital markets perspective. If we find a deal and we call up an LP and say, hey, we've got a deal in X market, sentiment is, ranges anywhere from love it, I wish I had more, I'm absolutely interested. At that top, average annual price growth over the following 5 years has averaged 1.9%. To the bottom bucket, which is, are you kidding me? And Houston's kind of, are you kidding me today, right? I don't want to bring a Houston deal to my investment community. They'll laugh at me given everything that's going on in Houston. Average annual price growth over the following 5 years in those situations has been close to 10%. What's interesting is trailing price growth. So this is the price growth leading into the year of the survey. Love it, wish I had more. Average price growth has been in excess of 18%. When prices are falling, that's kind of, that sentiment is reacting to that falling price growth. And yet, those are the places that become most interesting. Finally, just one more way of looking at this collectively, you've got the green bars are the average trailing annual return, and the blue line there is the average of the top 30 markets, kind of a ULI Z-score. And today, I haven't updated this for 2017. I actually just got the data into the spreadsheet, but it has ticked down a little bit. So sentiment has pulled back a little bit from last year. All right, let me talk a little bit about kind of noise. So job growth, trailing average or annual employment growth across kind of, this is the top 54 markets in the United States. Something we all focus in on, something that finds its way into our investment committee memos, and it certainly is a very important predictor of sentiment. So if you look at job growth and the relationship to future price growth, right, I've got 17,000 observations here in the United States where I'm looking at trailing annual employment growth, that's the x-axis, versus future price growth over the following 5 years of real estate prices. And there's no relationship. So it's not a negative relationship. It's neither good nor bad. It's just not a good focus or a good metric to be basing investment decisions on. How about real estate fundamentals? Vacancy rates, right? Again, we like to be investing in low vacancy rate environments. It makes us feel good. But the relationship is pretty much nil. And for the more statistical amongst you, I have tested this for fixed effects, and the relationship stays just like this. There is no relationship. So again, it's not a basis for making an investment decision. You don't want to be necessarily targeting high vacancy rate markets or low vacancy rate markets. It is what it is. And on the ground, in the year of that vacancy rate, it's a nice operational boost for sure. I mean, I'm not saying vacancy rates don't matter, but for making an investment decision that's going to last 5 years, it's not a good metric. Finally, rent growth, same relationship, which is zero. There is no relationship. In fact, the small relationship there is slightly negative, i.e. the stronger the rent growth has been historically, the less price growth has been over the following 5 years. And looking at that same rent data in another way. So I'm using kind of a histogram here. So I've got buckets of rent growth over the 26,000 observations globally. And looking again at the stronger the rent growth, there's really no difference across all of these buckets, whether rent growth has been weak going into the investment or strong going into the investment, price growth over the following 5 years, and that relationship is pretty much zero. So what do we focus in on? We focus in on price for our tactical investing decisions, right? And by tactical, I mean investment decisions that are going to last 3 to 5 years. And we really kind of measure price in two different ways. We just look at the price per square foot, our price per square meter in Europe and other places, and compare that to what I like to call long-term intrinsic value, which is influenced by construction cost and inflation, supply constraints, job growth, et cetera. That's what drives that long-term intrinsic value curve. And we look at cap rate spreads over other yielding assets, risk-free rates, corporate bonds rates, et cetera, and take those two things together to drive our price growth expectation. Now, what's really interesting in today's environment is that absolute prices, price per square foot or per square meter, are really high relative to intrinsic value, but cap rate spreads are incredibly wide as well. So the magic is putting those two together to create this price growth forecast, again, over the following 5 years. And you can see the relationship, relative to those other charts I was showing you, is quite strong. Just give you a couple of examples. I joined Hines in 2011, so I run global research for them. Prior to joining Hines, I spent 13 years with Property and Portfolio Research, which was acquired by CoStar, and Hines had always been a long-term client. Well, in 2006, Hines called us up. They had never been in Sacramento. They wanted to give us our opinion of Sacramento. And kind of this is the price of what we knew at that time. So this was what was going on in Sacramento in 2006. Rent growth was accelerating, approaching 6%. Vacancy rates were falling, and they were well below Sacramento's long-term average. Net absorption was averaging 2.7 million square feet per year over the prior 2 years. And job growth was running in the 2 to 2.5% range. So utilizing a kind of an economic forecasting-based methodology that I used to employ, we talked to Hines and kind of gave them the green light. We said, we like the market, it's healthy, it's strong, and things may slow down, but they're probably going to be pretty good. If we use a pricing-based model that we employ today, it would have suggested this. So that's what, given what we knew in 2006 Q4, what our current model would have expected in terms of future price changes in Sacramento. And I forecast on an average annual 5-year basis, knowing it's not going to be smooth like that, but understanding that, again, average term of investment is about 5 years. This is what actually happened in Sacramento. Okay, so pretty good tool to use, focusing again just on pricing, not an economic forecast. Take you back to 2011 Q2. This is the Dublin office market. I had joined at Hines at that time, and the market was an absolute mess. Unemployment was approaching 23%. Vacancy rates were approaching 23%. Unemployment was approaching 15% and still rising. Rents were falling. They had fallen 50%, and they were still falling 10% year on year. So the market was a mess. I ran the models, and it suggested this. And my Dublin team called me up and said, do you know what kind of rent growth and cap rate compression we're going to have to get for your 27% per year price growth expectation to come to fruition? And I said, I know, guys. It seems ridiculously high to me as well. It's not an easy market to model because it is so volatile and a little bit on the smaller side, so things can move quickly, and it's difficult. I said, but it gives us a lot of cushion to be wrong. If it's not 27%, maybe it's 10%. Do you think we can make a lot of money if it's 10% per year? And I said, yeah, okay. And this is what actually happened. So again, focusing on price is kind of what we do focus in on. And today, Ben's point about the cycle and how many different cycles there are going on, both in the United States and globally, is an important one because we tend to generalize about the market. And markets are all over the place. San Francisco is much, much later in its cycle than, say, a Milan, which is about 18 months into its cycle. So we need to understand that and continue to force ourselves to remain disciplined in how we think about markets and cycles. Thank you.
Thank you. So I'm going to start out kind of just laying, I've been spending some time looking at these charts, and we've talked about this on and off, and I'm like, so what are the big myths here? There aren't a lot. Because actually, you guys don't totally disagree on that much. So the dueling economist thing or research thing, I can't quite generate. But
I brush my teeth every day, no matter what.
And we know your limitations. We got that. But just kind of starting from a couple of things that are often talked about in the industry as guiding points. And I want to start with you, Josh. The whole idea of basically telling acquisitions people, portfolio managers, investment managers that all of these, long-term metrics that we've been using to justify our investment decisions, the combination, no one necessarily by itself, are really not the strongest indication of future value, is a little troubling.
Yeah.
So what are you suggesting that it really should continue to be a combination of all of them, or should we just start from scratch? And what does that do? Appraisers don't ever look forward, all right? They always look back. It's like, how can I prove this out from what I just saw? How do I justify all that? So all this backward-looking stuff has now become a bit suspect.
Yeah, I was as surprised as anybody when some of those charts I created, and looking back at history and what predicted future price growth, that vacancy rates didn't matter and rent growth didn't matter. I was shocked. I had to double check and get an analyst to look and make sure I was doing it right and check for fixed effects and all that. So I was really shocked and quite surprised. The reason I created the price-based model, let me just kind of back up. In 2011, Hines hired me to help them understand better where we were in the capital market cycle. And if I looked back on my career, having spent 13 years at PPR, and using an economic forecast-based model, and I kind of thought back to, okay, where did I go wrong? Well, 2006 and 2007 is where I think we were the most wrong as a firm in forecasting kind of the next 3 to 5 years. And the reason we were wrong is that our economic input into our models was expecting job growth to slow from 2.5 million to 1.5 million, right? So slow down, but still good job growth. We ended up losing 9 million jobs. And so when I got to Hines, I kind of knowing and looking back and thinking about that, I wanted to create something that took the economic forecast out of the equation, because economic forecasts are good 40, 50, maybe 60% of the time, but when you need them to be good at turning points, they tend to fail you. And so I spent 2 years doing R&D, and then once I started focusing on a price as the predictor of future price growth, it all kind of opened up and started happening. So price, it reflects current vacancy rates, current rents, right? It's not a secret that vacancy rates are low in an individual market, or that rent growth has been quite strong and people expect it to continue to be strong. So it's fully priced in. 30 years ago, if you knew the vacancy rate, you had an advantage over other folks, but today that's widely distributed and widely known.
However, so I'm looking at some of the information. Don't get me wrong, it looks like the Dublin numbers were based upon, post-GFC, the world is kind of recovering. Some of the other metrics that were used in comparing how, rear view mirror on rent growth and all that, those windows kind of went through the GFC. So if you're in an environment, and we've had some pretty major rent recovery in many, many markets, which has outstripped expectations, or pricing has changed in ways that weren't expected. Does being in a low growth environment alter any of that, or is it still going to be, look at where you are compared to construction cost, look at where you are relative to spread on bonds? Is that still, it doesn't matter what other sort of, I know there are other things, but that black swan event is something we can't judge.
Concurrent and job growth, right, with the term of your investment is a good thing. There's a positive relationship there. Concurrent rent growth is a good thing. There's a positive relationship to price growth. But you immediately get into having to forecast that. And the only way I know of to forecast those two types of things is to start with an economic forecast, right? You need to know what the demand for space is going to be by tenants. And that drives your vacancy rate forecast along with your construction expectations and your rent growth. And that gets all priced in the capital markets via interest rates. So the only way I know to get away from that was, again, it took a couple of years of working it out, and I've been using it now for about 5 years. So there's still more to be learned and known, is to focus in on price.
And we also don't think that that's impacted by market size?
By market types?
Market size.
Market size?
Dublin's relatively small. I'm just looking at the model, so I'm just trying to say, if I take that and take it into San Francisco, or I take that into Sacramento, those are two different scale markets with very different business drivers. Does that make a difference?
And different capital markets? Yeah. No, it hasn't. It has not made a difference. It tends to work just about everywhere. There are some places like Germany that are difficult because you had the fall of the Berlin Wall, and that caused all kinds of noise, I would say, in the 1990s. So you have to understand that and understand the strengths and weaknesses.
Yeah, but I mean, I think the issue is with how hard it is to forecast where the economy is going. The reality is economic forecasts are typically based on recent performance. To reiterate what you said, it's not that job growth and vacancy and rent growth don't matter for your investment performance. It's that it's really hard to forecast them. Most econometric models, fall apart after 12 months at the outside, and we don't live in a 12-month world. We live in a investment world, as Josh said, that's 5 years or longer out. And if you think about it, so it does matter having a view of where we are in the cycle, and the price is probably a good indicator of how hot things are. Certainly with the disruption from all the money that's washing around in the system, all the sort of equity that's out there right now is it feels like we've heated up. The thing that I think will extend this cycle, and why I think we're going to go a little longer than people predict, is because of the fact that it's been a jittery cycle, and I feel like, if you look at some of the places we typically get into trouble that take the wind out of the sails quickly, like over construction and extra leverage and things like that, they're not as prevalent right now. I would say if you're looking at a 5-year investment window, we're going to have a turn in the cycle within that window. You don't know when. My view has been, and what we've been advising clients is, there's a lot of money, because core has been so hot, there's a lot of money going to value add. You want to be able to add your value in the next 24 months and feel good about owning it, or buy something right off the bat that you want to own for 10 years through a cycle, because the cycle's coming. No, we're not going to get to the end of this decade without another cycle. But our view is it could go for a while before it turns. So it's too early to run for the gates.
But your economic prediction, which was a longer term cycle but very low growth.
Yeah, low growth, more low and slow.
What impact do you see that really having on some of the investment decisions? Because don't get me wrong, we're washing capital, but some of that capital is struggling with the low returns in the market, and having a little bit of schizophrenia over where to put their money. Yeah, they want to go into hard assets, and they believe that the real estate story is absolutely a long-term play for them. But if it's delivering 4% returns and they need 7% returns, I mean, is this continuing low growth going to have an impact on ultimately where they have to shift their capital?
I mean, yields are low everywhere.
True.
Right? So we're in a very low yield environment. I don't see that really changing anytime soon, not just for real estate in general, right? We're in as I said before,
higher risk investments.
So people are pushing out to higher risk for sure, and that's going to create probably some issues in terms of where some people go. But I think any sort of positive yield spread from risk-free, which is basically nothing everywhere around the world that has any sort of safety attached to it, I think is going to be attractive for a while. And I think low and slow keeps you away from, we always say it's very hard to predict when expansions end, but they don't die of old age. There's not like a clock that goes off or a buzzer that goes off. There's typically 3 things that end expansions. We did a bunch of analysis on cycles over the past like 60 years or so in the US at least. It's interest rates rising from monetary policy. We're just barely starting that. You could argue that we don't, it could only take a few turns of that to make a difference this time because of where we're starting, but we're not making much progress on that yet. Financial bubbles, and again, that's where we could get into probably a debate of is there a bubble in the sovereign bond market or in China, or there's probably some places, but we don't see it here. And the third one, which again, going back to the myth about the headlines, which gets all the headlines but rarely actually leads to a cycle turning, is geopolitical stuff. The only instance we found of that was actually in the early 70s, the Iranian Revolution, which led to an oil price spike and then to inflation, and that sort of turned a cycle in the US. But we don't tend to import cycles. We tend to export recessions, not import recessions.
So from a geopolitical perspective, right, doesn't really matter. Apparently Brexit was really an upside for the US anyway. May have not been great in London, but it actually worked pretty well with having capital move in other markets around the world, especially to the US. And you do say that gridlock that may come out of this election is a good thing. But gridlock usually means there's no really meaningful economic policy, which seems like that's another problem.
Just do no harm. That's my depressing outlook. No, I think look, the reality is in my view, that the likely outcomes, there are some probably lower probability outcomes, like a full Democratic sweep, or which could bring in some regulation or tax increases that could be perceived or actually negative for the kind of business community in real estate. But generally speaking, I think more gridlock. But both sides are generally for infrastructure spending, so you might get a little bit of bump from infrastructure spending. I think the heavier lifting things like like immigration and tax reform and are just going to be hard to get through any plausible scenario that I see from a political outcome of the election. So I think if you believe the polls, a Hillary White House and a Paul Ryan House with the Senate sort of could go 49-51 either way. It looks like at this point is probably going to be a fairly unproductive mix for a host of reasons. And I think the markets overall go, okay, more status quo, no harm coming. We're going to get back to work.
Okay, I'm fine with status quo. I mean, it's not the worst thing, but just trying to get comfortable with the fact that a continuing lack of direction has to, over time, result in a sort of stagnation that can't be positive.
Well, the big issues are coming, right? The entitlement reform, and there are some big issues out there.
Right.
There's some things that could happen with the judicial branch, right, with the Supreme Court, and depending upon it, that could have long-lasting impact. I just don't think they're near term. I think they're all going to push out a little further.
Okay. So let's talk about the Fed's discussion about its likely, I think now is perceived to be pretty likely, bump in interest rates in December. I mean, they're way off where they thought they would be. But yet, is there any reason to believe that unless there's a consistent series of interest rate increases that moves the needle on the Fed rate, 100 basis points over time, that doesn't have an impact on the real estate space?
I don't think it's going to have a material impact. I think cap rate spreads are wide, so there's a lot of room to absorb those increases. If you look historically at changes in interest rates, and I've always focused on kind of the 10-year rather than the very short term, changes in interest rates, positive changes in interest rates have been positive for real estate returns. So they've generated higher returns. Because interest rates don't rise in a vacuum. They rise because inflation's a little higher, and that can feed through rent and even asset prices. And economic growth is generally good. So higher rates have coincided with better returns historically.
So no reason to really fear that unless we have some really major changes.
Cap rates are inversely correlated with interest rates in the expansion part of the cycle most of the time, because of what Josh said. I think people kind of miss that. They just assume that they're correlated. And I think you also have to think about whether, there's this debate about whether interest rates are really high or low. You look at where interest rates are, obviously from any historical perspective, they're low. Right. But if you look at where they are compared to the rest of the developed world, in the U.S. they're high, right? And so we're importing deflation from the rest of the world, importing some fear in the rest of the world. And even if the Fed bumps up the short end a little bit, there's some question about what happens. Does the long end really follow that much anyway?
Well, in a low interest rate environment, a low growth environment, it seems like almost any sort of change is magnified differently than from what we're used to. So if you're in an expansionary, you look at your chart, the prior recoveries were far stronger growth models, and therefore if you had interest rate movement, maybe that magnified it, or maybe it made it easier. When you have a low growth economy, does that change the dynamic of what these interest rate changes could do? Or is that just, a guess?
Our view is that the real economy can handle a quarter point in December and probably another one at some point in the first half of next year. The question more is, can the financial markets handle it? Right. In my view, and that's the bond market would tell you that they're at odds with the Fed in terms of what can be done. They've been saying that for a long time, and they've generally been right. I think they've sort of backed the Fed into a corner to some extent, but the real economy can handle it. It takes a while for any interest rate to sort of rattle through the real economy and make a difference.
Talking about cap rates a little, it appears as though with the strength of capital coming into the U.S. markets in particular, cap rates have converged in virtually all product types. I mean, the gap's not nearly what we are used to seeing, right? So even, when you look at how they all cluster together somewhere in the 3.5% to 4.5%, maybe 5% range, doesn't it seem like there is a missing risk adjustment in that? I mean, I would imagine that realistically, longer-term leases versus short-term leases and certain product types have different risk levels. That convergence of cap rates, does that mean we're missing something? Is that convergence potentially leading us to some sort of industry correction, or is it just the way life's going to be going for a while?
Convergence of cap rates or convergence of pricing overall is a big red flag. It happened in 06 and 07. Everything got expensive. Then everything got very inexpensive. So I look at pricing around the world, and there's a definite difference in pricing between Phoenix and San Francisco, or
well, I'm talking really kind of top tier stuff. I mean, if you're actually
across the property types.
Across the property
it's
types.
Not a good sign, right? Because there are different capex profiles, and that's a very important part of any cap rates. I think as an industry, we do tend to get a little obsessed with cap rates because it does move the needle so much on our pro formas. But if you look at interest rates and cap rates around the world, one of the things I've noticed just in the last month or so, that cap rates in Brazil really didn't move with all of the economic distress in Brazil. It's the worst recession in 100 years. And cap rates on real estate, on good product, really didn't move all that much. However, rents fell 20-25% in real terms, in dollar terms, more like 50%, and asset values went down 20-25%. So even though cap rates stayed low, asset values declined significantly. The other place that's very true is in Warsaw for a very different reason. Warsaw is kind of the little engine that could in terms of its economy. Its demand has been great, but there's been a lot of supply, a lot of developers, including ourselves in Warsaw, that have delivered space and driven vacancy rates up into the 20% range. Cap rates have not moved. They've stayed low. They've actually ticked down a little bit, but rents have come off 5-10%, and asset values have declined as well. So we have to remember there's a numerator that we're capping, and keep that in mind.
I was reading another report. I've had to do a lot of stuff to kind of make sure I was up to speed with these guys. But there's a whole dialogue around U.S. investors leaving trophy assets to global capital. It starts to sound a little bit like, the Asian invasion that was buying like all the mega buildings in New York. And, are you sensing any concern about the long-term loss of trophy U.S. assets into global capital because their timelines tend to be longer? They aren't known for being, short-term investors. So really, the loss of that investment platform or profile in some of the U.S. portfolios, is that a concern? Or is that real? Actually, that may just be an assumption. It may not really be the case, but I'm hearing that more and more as a concern.
It was a concern with the Japanese in the 80s as well, right? And then that reversed itself. So, we're partners with, a lot of that capital that you mentioned, and they've been great partners and a good source of capital. So I think it's a good thing for the industry. I'm not too concerned about it.
Yeah, and it's real. The foreign capital's been pouring in. If you look at, I think, we did an analysis of sort of a trophy set of office buildings across core markets. I think it was something like 15% or 20% of it went to foreign, which was up a little bit. New York is like 45 or 50%. So there's a spectrum there, and again, with the return environment around the world and with the comparative growth, again, some of those forecasts could be wrong. That growth may or may not last, but I think you'll continue to see that. And then you add on just the general increase of allocations to real estate. When you're in Germany and you're willing to, German fund willing to accept a 3 unlevered or whatever it is now, that's not going anywhere, I don't think, anytime soon. So that's coming in, and then you get the domestic stuff, domestic capital sources pushing out more into core plus and value add.
But we're also seeing some cross-border capital going into secondary markets in somewhat of a return, a search for yield. Do you think the dynamic of continuing to push up pricing and push down returns in those markets we'll see in the secondary markets the same way we've seen in the primary core assets?
I think it's more of a ripple effect than a direct effect from foreign. Something like 90% of the foreign direct investment in real estate has been in primary markets. But then you have displaced domestic investors who are trying to find out what can they do next. So there's certainly a ripple effect, but I don't see the big foreign capital sources going deep into secondary markets.
And I think it'd be fickle as well, right? As opportunities open up in the primary, they want to be in the primary markets.
Right.
So as the cycle does what it does and opportunities become available, They'll be back in those primary markets. But it is, it's generally longer-term capital. One thing that's interesting with the big foreign capital sources out of China or even French insurance companies is that they want to be in high-quality assets. And high-quality trophy assets don't come up for sale in 2009, right? The lenders stick with the equity sticks with because they know it's good quality real estate. And so they're forced to generally pay at fairly lofty kind of cyclical prices, but over the 10 to 15, 20-year hold that these folks expect, those prices will cycle, but they'll generally rise faster than most places.
Right. And one last question. So there will be a reset, 1, 2 years, 3, 4 years. There will be one, right? In the 2008, 2009 cycle, there were opportunities that were a result of some of the upheaval in the industry across financial sectors, and people weren't quite prepared for that. Right? And they missed some really great opportunities. One, because of fear, right? There was that whole kind of falling knife problem. Oh, well. But still, it was just they weren't prepared for the depth and the opportunities that were there. Their capital wasn't there. So we're looking at, there will be another one. We don't think it's going to be nearly as dramatic as this last one. Any thoughts on where people might want to prepare themselves for an opportunity or something they might want to look at that you've seen your peers talk about?
I'd play, that's where because you don't know exactly where it's going, where or when it's going to happen, that's where I sort of go back to demographics and some of the structural shifts that you see around technology and demographics. And you think about markets that have some affordability outside of the hot ones. You think about the redistribution of technology across a lot of different industries. Again, you think about affordability, you think about the millennials going into their 30s and into their 40s over the next 5 to 10 years, and a push potentially back into the suburbs. You think about baby boomers all around healthcare, but also coming into the rental market in a bigger way. And so I would play. That would be sort of where I'd be ready to play a little bit. Some of those you're already getting in some of those cases because they're not core downtown. Probably more yield right now, and it feels like it's probably a little bit risky because liquidity isn't there like it is in a big downtown gateway market. But to me, if you have some cash, that's going to be I think there'll be opportunity around those trends in the turn.
I mean, everything we're doing today in the markets that you want to be in, the big primary markets, are on long-term hold basis with the appropriate structures and partners to kind of go through a cycle. And in a lot of these deals, we're saying to our partners, listen, we fully expect a cycle over the next 5 years, and prices are going to go down, they're going to come back up. Those will be paper losses. We'll have long-term gains. And the income profile is tight, so we can kind of get through any type of recession, even with, if a tenant goes BK or whatever. So, that's what we're primarily doing today. We are doing a little bit of tactical investing kind of on the margins. We're doing some value add. We recently picked up an asset in Washington, D.C. that had a really interesting profile, kind of traditional value add, fix up the asset, lease it up, in a market that is kind of counter-cyclical. So D.C. got overbills. Sequestration dropped job growth to 0. Today, job growth is accelerating in Washington, D.C., one of the handful of markets where job growth is accelerating. Everywhere else, it's kind of slowing. I
thought that was a bad sign.
In San Francisco, it's neither here nor there. In San Francisco.
Okay, so wait a minute. We can talk about it, but it doesn't have an impact at all.
But it's a market that's, again, if you look at the sentiment on Washington, D.C., it got really sour in a primary market, and as job growth accelerates, that tends to impact sentiment. So, we're like that. And there are places like Orange County that have had such a recovery, and we were able to participate in it in a pretty big way, but we're harvesting gains. So, in terms of markets themselves, you've got Houston and Calgary, which are all the way on the other side of their cycles and actually going down. So they're starting to look interesting. We bought recently in Calgary. I would be shocked if we didn't do something in Houston over the next 12 to 18 months in terms of buying a broken multifamily development deal or even an office asset that's under distress. You've got markets like a San Francisco where we're building, but again on a long-term hold basis. But I would fully expect a cycle in the next 12 to 24 months to ensue in San Francisco. Supply is not an issue in general, but in San Jose, the Silicon Valley, 8% of office inventory is under construction. That is a significant and large amount for that market, right? Which is considered to be somewhat supply constrained. In Nashville, over 12% of the apartment inventory is under construction. So there are pockets of supply, and generally they correlate to the markets that are the most expensive. All right, expensive. Again, focusing on pricing, what does it do? It generates construction activity.
Nashville expensive?
Nashville is expensive, yes.
That's
Not relative to New York, but relative to Nashville.
No,
yes.
relative to Nashville. Okay. It's all about the company you keep. We've now got about 10 minutes for questions. If anyone happens to have one for these guys, there's a microphone there. We'd love to have you pick their brains or maybe come up with another myth they need to beat up. Mr.
Okay,
Ravitch.
I think Ron Ravitch. Josh, I think I've got it summed up. The real estate markets have finally become efficient after all these many years. I think that's what you said. And we've got about 2 more years of muddling through growth as we've had in the past. Let me throw another issue out to you. I think we have such a sensitive economy. People are so nervous about almost anything that a very small black swan, a very small one, a minor terrorist event, a Lady Gaga concert, Lady Gaga and 2 others get killed by a bomb from a terrorist. It would be on the news for the next 3 days. What would that do to the economy?
Oh, my.
Yeah, those geopolitical risks are...
There's geopolitical risk right
Yeah.
there. Okay.
The thing about low growth is that it does feel like it wouldn't take much to tip you into a recession. I think if we do have a recession, there are a number of signs, particularly on the corporate side. So profits are getting squeezed, and they're going to get squeezed more as wages have finally started going up. Investment is down and poor. Factory orders are weak. There are a number of things that on the corporate side would suggest much slower growth, if not even outright recession. But I don't think it's going to be strong and long. I think it's going to be a slight dip. It's not going to last very long. It's just a kind of a quick reset. I mean, growth is the norm, right? Growth happens 90% of the time on an annual basis. Growth in the United States is 90% of the time. So recessions are very rare. They do happen. They happen because imbalances build up, and those imbalances have to be corrected, and they get corrected via recession. So I just don't see huge imbalances like we saw heading into the housing market. That said, if I look back at 2006 and we looked at home prices relative to incomes, you could see that massive imbalance there, and home construction was responding to that. And we expected the housing market to slow and that to have kind of a ripple effect on job growth. What we didn't understand, and you never understand fully until you look in the rearview mirror, is how long the tentacles were of that situation and that imbalance. And that's what caused the GFC. And China's one where, how long are those tentacles, right? They've got some serious debt imbalances in China that people say, well, they got $4 trillion in reserves, they can kind of manage that, and perhaps they can, but there could be tentacles and unexpected things that we just don't understand in foresight.
Josh, do you have a correlation chart of Lady Gaga to the price growth? Because I haven't seen that anywhere, I don't think, but we might have to do that for next time. I mean, just to the specific question about sort of some small black swan, the history just doesn't bear out that it should matter. And you could argue that the history in past cycles is, we were in stronger growth mode, but even in this cycle, I mean, we've had some pretty big things, not terrorists specifically, but there's been some pretty big things that have, you would expect would have rattled this cycle, and they just haven't. So, and then on the some of the warning signs, I would agree that there's some concern about the business investment and corporate profits and things like that, but I also think at this point in the cycle, there's a little bit of natural wealth transfer through wage growth, as you said, to the consumer side, which then hopefully can, consumers have been saving a little bit finally, but hopefully that, that combination is of low oil prices and a little bit of housing growth and job and wage growth starts to kick in, and consumers can kind of carry us through more of that low and slow.
Thank you. Yes.
Testing. Okay, good. Michael Bloom from the Houston market. I'm a first-time national ULI meeting attendee, so I'm excited to be here.
Welcome.
Great information. Had a question about the input to the price model that you were using. I was talking to somebody about the issue of office vacancy and the price asked for a new office building that's vacant versus the price asked by someone who's trying to sublease empty space because they don't have any people working there anymore. And I'm wondering if you could talk a little bit about the price inputs and kind of how you look at that sublease price versus the new price.
Yeah, so you're talking about more rents, right? So the space market fundamentals, and that's we do a similar kind of situation with rents, right? We do forecast rents, and we're kind of looking at rents relative to kind of the long-term trends. And in a lot of markets today, what you find is that the capital markets got way ahead of the rent growth, right? So pricing kind of in expectation of rent growth got a little over their skis. And as long as rents are rising or rent growth is accelerating, that is fine. But as soon as rent growth begins to slow or even rents fall, like Houston, the capital markets, whipsaw and react very, very quickly. So it'd be interesting in San Francisco, right? San Francisco apartment rents fell in the most recent quarter. It would be interesting to see how cap rates react to that, because you can no longer just stick in 6% rent growth into your pro forma and justify the price of paying a 2.8% cap rate for San Francisco apartments. You've got to be a little bit more realistic about your rent growth expectations.
So your input is acquisition of the facility, not the rent part.
Yeah, I mean, rents is something we do forecast, but just looking at asset values, yeah.
Any other questions for the experts here? Okay, well, I'd like to say thank you, Ben, thank you, Josh.